Welcome to today's edition of the Lance Roberts Show podcast. Of course, you can find all of our podcasts on our website at realinvestmentadvice.com. Our podcast, our YouTube channel is there, as well as our newsletter, daily blog posts, more. It's all there. Of course, all of our great interviews that we have every week, you'll find in our library on our YouTube channel at realinvestmentadvice.com. Our special guest today is Daniel Ruiz. He is the founder of Blinders Off Research. It's an institutional research platform for basically talking about what happens through the entire automobile sales cycle. This is incredibly important considering that next to houses, automobiles are some of the most expensive things that people buy, and are a good indication of what's happening within the global economy. Is the economy really growing? That's the question we want to look at today with Daniel. So Daniel, let's start a little bit broad picture here, because just recently, Jerome Powell, chairman of the Federal Reserve, came out and said that, well, maybe we need to start, rethinking about these unconventional monetary policy measures that we've been running for the last decade, which is zero interest rates, quantitative easing, et cetera. Maybe those should be part of the conventional thinking. Maybe that should just be part of the regular playbook. Did you find anything strange about those comments that he made?
First of all, I want to thank you for having me on your podcast.
Sure.
I'm a big fan, and jumping right into it, the actions being taken by the Fed right now should definitely give investors some pause, because a very rosy picture is being painted, but there are definite signs in important sectors, like you just mentioned, autos, that are showing that the consumer is starting to struggle a little bit, and that'll definitely be the topic of our conversation. I think there's also a very, very important distinction between housing and autos. I think you and your team have done a really, really good job of predicting where interest rates were going to go. And to that effect, some housing stocks have performed really, really well because, as we well know, as interest rates fall, affordability increases, buying power increases for the consumer. But there's a tremendous distinction between what's going on in housing in terms of interest rates and what's happening with autos. And the reason why I think investors need to be very, very keen on the differences between the two is because through the policy that we've had with interest rates, auto prices have increased substantially. That's
right.
What lowering interest rates typically does. It inflates asset prices.
Sure.
The challenge, though, is that when interest rates started rising, I want to say it was in 2015, transition between 2015 2016, as it relates to autos, the auto companies decided not to transfer those extra expenses onto the consumer, and they started subventing interest rates. Mm-hmm. And all that means is that they're buying down higher interest rates to offer 0% financing for 60 months, 72 months, and that's allowed for the asset to continue to inflate. So I think that's something that's critically important for the viewer to understand, is that while interest rates going down for mortgages could help stimulate the housing environment or the housing market by increasing affordability, we've already reached a critical point in terms of financing for autos because manufacturers never transferred that cost onto the consumer.
Let me just ask you a question, because you bring up a great point here. But when interest rates decline, yes, you're right. I can buy more house because I have a lower interest rate. And again, I've written about this before, Daniel, that none of us buy a house. We don't buy a house. We really don't buy a car. What we buy is we buy payments, right?
Agree.
What if you can get me in a low enough payment, I'll buy a Bugatti, but you're just gonna have
Amen.
to get me.
You're to the fire.
I'm gonna need negative interest rates to get there. But the point is that kind of the same thing happens though, right? In both autos and housing, is that consumers get themselves into trouble because as lower interest rates come down, we buy more house than we can actually afford because, we don't think about the consequences of buying a house, right? We've got property taxes, you've got upkeep and maintenance. The bigger house you buy, the more costly it gets. And we saw that really kind of occur back in 2008. My question kind of relating to that to today is kind of we're seeing the same thing in the auto sector, right? Lower interest rates. And again, at the end of economic cycles, you see companies come out with employee pricing and 0% financing to move that inventory. But did we see the same thing kind of occur in the automobile sector as well as interest rates drop, people trying to buy more car than they could really afford, which is why we were stretching out payments to 8 years for financing, et cetera?
You hit the nail on the head. It is literally all about payments and affordability. Now, my observation of the housing market, although I'm not an expert on housing, is that leading into that 2008 serious decline in housing, part of the issue is that there was a lot of speculation on home pricing. Home prices were allowed to rise because we were in a declining rate environment. Affordability was increasing for the consumer. When we ran out of that lever, so to speak, where you can lower mortgage payments by lowering interest rates, then they started piling into adjustable rate mortgages.
Right.
Again, simply to keep the payments lower, and that allowed for pricing to continue to increase. When that reached its limit, they moved to interest-only loans. Again, a mechanism to allow the monthly payments to drop so that the consumer can afford the house. And there was a lot of speculation around that. But it all goes back to the payments. As long as the payments are affordable, by some means, the means being financial engineering a lot of times,
right?
Then the asset prices can continue to increase. And as long as asset prices are increasing, there's very little risk in the system, right? It's when you run out of that mechanism that allows for monthly payments to remain affordable, and the only thing that you're left with is price cuts in order to make the monthly payments affordable. That's when you get into serious trouble, because when you lower the price, for example, of a new house, think of a new car like a new house.
Right.
When you lower the price of a new house because your inventory is backing up and you start cutting prices, well, that's great. You think that's going to stimulate sales, but then you start affecting the value of existing homes on the market. And you need those homes to sell in order for those folks to buy your product.
Yep.
Existing homes are kind of like used car values because there's so many folks in the new car market have a vehicle to trade. And when you start lowering the price of new vehicles, it impacts the value of the used car, which is a huge part of the consumer's purchasing power. When price cuts start taking shape, there's a domino effect that comes into play that's very negative for autos, I know for certain, and in theory for housing based on what I just said. So that's what's got me very, very concerned. Again, I think I could be wrong on housing. Again, I'm not an expert. There could be a possibility of lowering interest rates and having those monthly payments come down, which can support pricing further, to stimulate, home sales. But we've already reached the critical limit in autos, in my opinion, because the auto industry chose to continue to cement rate well past the rate hiking cycle, which allowed prices to continue to inflate.
Yeah, let me ask you, we need to take a quick break here. I want to come back. We're going to come back more with Daniel here in a second. But Daniel, I want to ask you a little bit, we started talking a little bit about the Fed and Fed policy and why they're talking about cutting interest rates now and really kind of going back to emergency measures. When we come back, I want to ask you about what's the Fed really saying about the economy? Because I think it reflects through to what you're talking about with autos. And I'd also like to touch a little bit on cash for clunkers and what happens to negative equity in automobiles when we start stretching out auto loans for 8 years. So lots more coming up with Daniel Ruiz. BlindersOffResearch.com is his website. Also, follow him he is a great Twitter follower. I got to follow on Twitter because just really interesting stuff coming out all the time. DRuizG80. We'll put that up on the screen for you right here. Follow him on Twitter today. We'll be right back. More of the Lance Roberts Show podcast with Daniel Ruiz right after the break.
You can get daily real investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at realinvestmentadvice.com.